Cardinal Health just put up an absolute monster of a quarter, and the stock went nuts. I'm with Talk Tickers, and today we're going to break down the numbers, the strategy, and exactly what signals ignited such a fiery, bullish response from the market. Let's dig in. So, the very first signal came before the opening bell even rang. Right after the earnings dropped, Cardinal Health stock shot up about 9%. Now, this wasn't some sleepy little drift upward. It was a powerful, decisive move. It told you right away that investors saw something they really, really liked. So what was it?
Well, the story starts with a classic beat and raise, which you love to see. But what's really turning heads here is the size of it. Cardinal didn't just squeak past expectations. They delivered a quarter so strong it gave management the confidence to seriously lift their outlook for the entire year.
And when I say strong, I mean it. Adjusted earnings per share came in at $2.63, which just blew past the consensus of $2.36. That's an 11% beat. Then you look at the top line. Revenue hit almost $66 billion, a full $1.5 billion more than expected. But as great as these numbers are, the real juice was in the guidance.
Yeah, those Q2 numbers are impressive for sure, but Wall Street is always asking, what are you going to do for me next? And that's where management sent its most powerful signal by showing incredible confidence in the year to come.
And this chart right here really tells the story. Management didn't just nudge their guidance up, they absolutely launched it. The new full-year EPS range now sits completely above their old floor and the analyst consensus. The message to the market was crystal clear. Hey, you guys are still way behind the curve on this.
Okay, so that leads to the crucial question. How are they doing it? Right? This isn't just a case of the whole market lifting up. This is the direct result of a very deliberate and very successful focus on a higher margin part of their business.
Man, you don't have to guess either. The CEO, Jason Hollar, put a huge number on it. He said they expect to surpass $50 billion in specialty revenue. Let that sink in for a second. This is not some small side project. This is becoming the absolute core growth and profit engine for the entire company.
So what exactly is this specialty business? Well, think of it as a combination of a few high-growth areas. You've got the core specialty distribution for complex drugs. You've got their MSO platforms in super valuable fields like oncology. And on top of that, they're riding these powerful tailwinds from biosimilars. In fact, management has a great name for it. They call it the specialty flywheel, where each part makes the others spin faster and faster.
And all that confidence from the specialty engine is just cascading through the rest of the business. You can see it so clearly when you look at how they updated their forecasts for each segment. This is where they really telegraphed their internal expectations. It's like reading their playbook.
I mean, just look at this upgrade. For the Pharma segment, their biggest business by far, they raised the profit growth outlook from an already strong 16 to 19% all the way up to 20 to 22%. That's not a minor tweak. That is a massive signal of confidence in their execution and their pricing power. And holding all this up is a much stronger balance sheet. Cardinal got its debt levels back down into their target range way ahead of schedule. And that's a huge deal because it gives them so much more flexibility, more firepower for acquisitions, for investments, or for returning more cash to shareholders. They have options. Okay, so that's the story of the quarter. Now let's put on our analyst hats here at Talk Tickers. What's our take on what's coming next? Based on all this momentum, what should we expect heading into the next earnings call and beyond? We see three key things playing out. First, that earnings momentum from the specialty flywheel, we think that's going to keep rolling right through the rest of the year. Second, given how things are going, another little bump up in guidance wouldn't surprise us at all. And third, all of this great execution and clear strategy should keep investors interested, which should act as a nice tailwind for the stock price.
So when you tie all of that together, what's the bottom line? For us at Talk Tickers, our rating on Cardinal Health is a clear outperform. The company is just firing on all cylinders, their big bet on specialty is paying off big time, and we think the market is still underestimating the true earnings power here.
All right, so with that outperform rating in mind, how could you actually act on this information? Let's frame this next part as a plausible trade idea, kind of like how we'd pitch it to our own investment committee.
So the big question for any investors becomes, how do you position yourself for this continued momentum? Our core belief is that while the market loved the recent results, it probably hasn't fully baked in just how durable this growth story is.
So here's the pitch. 1. The thesis. The combination of their strong core business and that accelerating specialty flywheel is still being underappreciated. 2. The structure. It's straightforward. Establish a long position in the common stock, symbol CAH, to capture that upside. And 3, the target. We would raise our price objective, taking the midpoint of that new EPS guidance and applying a stable PE multiple. This is a story about earnings growth driving the stock higher.
And that's our take on Cardinal Health's incredible quarter. Now, as a final and very important reminder, this analysis is for informational purposes only. It is not financial advice.